All right, welcome to the Tuesday Tidbit. Today's Tuesday Tidbit is, how does being retired impact mortgage qualification? It's a great question. There's really two times in life where it's the hardest time to get a mortgage. Okay. Number one is when you are newly self employed. When you're newly self employed, the lender's going to want to see at least a 12-month history, if not a 24-month history, so 1 to 2 years of self employment before they can use that income for qualification. When you're newly retired is another tricky time to get a mortgage. And the reason why is because when you're newly retired, you're probably not receiving all the income that you will be ultimately receiving, right? You might not start Social Security right away. You might not start your IRA distributions right away. You might not start receiving a pension right away. So a lot of times people will live on their assets to start, and then they start to use their retirement accounts later on down the line. Makes a lot of sense. It's very financially responsible. And honestly, it's great, except for when you're trying to get a mortgage. Okay. So we cannot use, hey, I'm going to be receiving Social Security in the next couple of years. We cannot use that as qualification. We cannot use a future pension. We can use a current pension to qualify them. The easiest way to qualify somebody when they are retired is using distributions from a retirement account. Now, there's a couple different ways we can do that. Okay. One, a lender can do what they call asset dissipation or annuitization of assets. What it is it's a lender's calculation. They look at your assets, they make sure that you're of retirement age, and then a lender can calculate an income stream from those assets. It tends to be a very conservative calculation. They typically are calculating your income over the course of like 20 years. So it can be very, very conservative. Another option is a lender can show that you've set up recurring distributions from a retirement account. You have to be of retirement age. You have to receive one retirement distribution prior to closing, and we have to show that that income is going to continue for the next 3 years. So instead of having to use 20 years as a basis of this income, we only really have to show 3 years continuance of the income. Again, you have to be of retirement age. We have to show that you're set up on recurring distributions. You have to receive one distribution prior to closing, and we have to show that that income is going to continue for at least 3 years. Yes, it mean you have to start distributions on your retirement account a little bit earlier, but I will also say after closing, we don't have to verify anything else. Okay, so we just have to document this to show the investor, Fannie Mae, Freddie Mac, whoever, hey, look, this is how we're calculating their income. They've done recurring distributions. Here's how much they're receiving. Here's proof of one payment being received. That's all a lender has to do to verify that income. Whatever you do after closing is up to you. We no longer have a say in any of that. Hope that helps. Thank you all so much. See you next time. Bye.